Yo, what's up everybody? It's Bcash. And let's be real. You clicked on this video because you want to learn how to invest. Maybe you got your first $1,000, maybe you got $10,000 laying around, or maybe you're starting with a lot less. That's totally fine. Whatever it is, we're going to go over everything you need to know to start investing your first $1,000, even if you have no idea where to begin. Investing can seem super complicated and confusing, but it doesn't have to be. I'm going to break it down in a way that's easy to understand, even if you're a complete beginner. The first thing you need to understand is the power of compound interest. It's a concept that can transform your financial future in ways you might not even imagine. This is like the most important thing in investing. It's the secret sauce that can turn modest savings into a substantial nest egg over time. Compound interest is like magic, but instead of pulling a rabbit out of a hat, it's pulling money out of thin air. Imagine your money working for you, growing while you sleep. It's basically earning interest on your interest. This means that not only does your initial investment grow, but the interest it earns also starts to earn interest. Let me give you an example. Let's say you invest $1,000 and it earns a 10% return. This is a simple scenario, but it illustrates the point perfectly. After the first year, you have $1,100, right? That's your initial investment plus the 10% interest. But here's where the magic happens. The next year, you're not just earning 10% on your original $1,000, you're earning 10% on $1,100. This means your interest is also earning interest. So you end up with $1,210. And this process continues, with your money growing exponentially over time. See how that works? The longer you let your money compound, the more powerful it becomes. It's like planting a tree and watching it grow taller and stronger each year. It's like a snowball rolling down a hill, getting bigger and bigger. The momentum builds, and before you know it, you have a substantial amount of money. And the best part is, you don't have to do anything. Just let your money sit there and do its thing. Over time, you'll see the magic of compound interest work its wonders, turning your small investments into significant wealth. So, you're probably wondering, where do I even start? Investing can seem overwhelming, especially with all the options out there. Stocks, bonds, mutual funds, real estate, the list goes on and on. But don't worry, you don't need to dive into the deep end right away. Well, one of the easiest and most accessible ways to start investing is with a high-yield savings account. It's simple, straightforward, and doesn't require a lot of financial knowledge to get started. You can open one online in just a few minutes. Now I know what you're thinking. Graham, a savings account? That's so boring, but hear me out. While it might not be the most exciting option, it's incredibly practical, especially for beginners. And yeah, you're right, it's not the sexiest investment out there. But sometimes boring is good. Boring can be safe and reliable, which is exactly what you need when you're just starting out. But it's a great place to park your money while you're figuring out what you want to invest in. You can let your money grow with interest while you take your time to learn about other investment options. Plus, high-yield savings accounts are FDIC insured, which means your money is safe even if the bank goes bankrupt. This insurance covers up to $250,000 per depositor per bank, so you can rest easy knowing your funds are protected. And right now, interest rates are actually pretty good. With the current economic climate, banks are offering competitive rates to attract new customers. You can find high-yield savings accounts that are paying like 4% or 5% interest. This is significantly higher than what you'd get from a traditional savings account. That's way better than the 0.01% you're getting from your traditional brick-and-mortar bank. It's almost like getting free money for doing nothing more than moving your savings to a different account. So, while you're learning about other investment options, a high-yield savings account is a great way to at least get some return on your money. It's a smart, low-risk way to start your investing journey and build a solid financial foundation. Chapter 3. Index Funds. The simple way to grow your money. Now let's talk about index funds. Index funds are like the superheroes of the investing world. They're diversified, low-cost, and they've consistently outperformed most actively managed funds over the long term. An index fund is basically a basket of stocks that tracks a specific market index like the S&P 500. So when you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in the index. This diversification is key because it reduces your risk. If one company in the index tanks, it's not going to sink your entire portfolio. And the best part is, index funds are super low cost. You don't need a fancy financial advisor to manage your money for you. You can just set it and forget it. Chapter 4. Individual stocks risky, but potentially rewarding. Now, if you're feeling a little bit more adventurous, you could always invest in individual stocks. This is definitely riskier than investing in index funds, but it also has the potential for higher returns. When you invest in individual stocks, you're essentially buying a small piece of ownership in a company. If the company does well, the value of your stock goes up. If the company does poorly, the value of your stock goes down. It's pretty straightforward. But here's the thing. Picking individual stocks is hard. Like really hard. Even professional investors struggle to beat the market consistently. So, unless you're willing to put in a ton of research and you're comfortable with the risk, I would recommend sticking to index funds. Chapter 5. Don't put all your eggs in one basket. No matter how you choose to invest your money, the most important thing is to diversify. Diversification is a strategy that can help you manage risk and reduce the volatility of your portfolio over time. By spreading your investments across various financial instruments, industries, and other categories, you can potentially improve your returns. Diversification is just a fancy way of saying, don't put all your eggs in one basket. Imagine if you had all your savings in one stock and that company went bankrupt. You'd lose everything. But if you spread your investments across multiple stocks, bonds, and other assets, the risk of losing everything is minimized. You never want to have all your money invested in one stock, one sector, or even one asset class. Diversifying your investments means that you are not overly exposed to any single risk. This approach can help you achieve a more stable and predictable performance in your investment portfolio, because if that one thing goes south, you're in trouble. Market downturns are inevitable, and having a diversified portfolio can help cushion the blow. When one investment performs poorly, another might perform well, balancing out the overall performance of your portfolio. A well-diversified portfolio should include a mix of different asset classes, like stocks, bonds, and real estate. Each asset class has its own risk and return characteristics, and they often perform differently under various market conditions. By combining them, you can create a more resilient portfolio. It should also be spread across different sectors and industries. For example, you might invest in technology, healthcare, and consumer goods. This way, if one sector is hit hard by economic changes, the others might still perform well, helping to protect your overall investment. This way, if one area of the market is struggling, the rest of your portfolio can help to offset those losses. Diversification doesn't guarantee against loss, but it is a powerful tool to help manage risk and achieve more consistent returns over time. Remember, investing is a marathon, not a sprint. It's about patience, discipline, and making informed decisions. Over time, a well-diversified portfolio can help you navigate the ups and downs of the market and work towards your financial goals. It's about making smart, informed decisions and staying the course, even when the market gets bumpy. By diversifying your investments and maintaining a long-term perspective, you can better weather the storms and enjoy the rewards of your investment journey. Outrow start investing today. So, there you have it. Those are the basics of investing your first $1,000. Remember, the most important thing is to just start investing. The sooner you start investing, the sooner you can start taking advantage of the magic of compound interest. And don't be afraid to make mistakes along the way. Everyone makes mistakes, especially when they're first starting out. The important thing is to learn from those mistakes and keep moving forward.